I'm Brian Cosgrove, and this is the Patient Capital Commentary for Tuesday, November the 22nd, 2011, titled Patient Capital, How to Use It. In yesterday's post, I discussed some of the economic thinking behind why the evolution of the labor markets may require a more flexible form of home financing for moderate and middle-income borrowers in the future. Today, we'll look at some of the financing implications of the concepts in practice. Urban settings, by virtue of their concentration, provide for greater specialization of labor. This specialization of labor can produce significant economic surplus. If the surplus becomes concentrated, as it has in the technology-leveraged capital business model, the purchase power of the technology user can outrun other middle-class professional occupations. Teaching is a critical resource in any community, yet in many urban communities, teachers cannot afford to live in the communities where they work. Rental housing is a reasonable alternative to expensive homeownership, but the renter is left out of the tax subsidies enjoyed by homeowners and the wealth storing that long-term homeownership creates. In recent years, homeownership has gone from being a measured way of storing wealth to a risky gamble for some. Much of the risk was caused by the borrower being required to use too much debt, relative to their income, to acquire a property. In our new technology-driven economy, interruptions of wages or the downsizing of wages are increasingly common. So having a mortgage payment which can provide the capacity to absorb these disruptions is increasingly necessary. Using patient capital, the objective is to right-size the amount of debt and equity a borrower uses to obtain homeownership rights. In the example to follow, the patient capital is provided by an investor class whose investment objectives are long-dated and whose capacity for credit risk is moderate to low. The patient capital is secured via a lien on the property, but rewarded by sharing in the property appreciation rights, which exceed the current purchase or appraised value. No payment is made against this contract until the borrower refinances or sells the property. Here we have a simple example illustrating the patient capital concept. We're going to zoom in on the characteristics and assumptions used in this set of scenarios. The borrowers are purchasing a $300,000 property. They have a 10% deposit of $30,000 to contribute to the purchase funds. Their equity partner is providing a $60,000 patient capital investment, and that leaves the borrower with $210,000 in a first mortgage. Without making this overly complicated, we're assuming the borrower's note rate will be 5%, and for this rate, the mortgage investor will pay the lender enough to cover the premiums associated with the transaction costs. Our borrower has a 30-year fixed-rate payment out of this of $1,127 per month, plus property and insurance costs of about $262 a month, for a total monthly housing cost of $1,389. Ideally, this housing cost will be close to 28% of the borrower's gross monthly income. This house cost-to-income ratio has generally proven very workable over the history of U.S. housing. In this case, if our borrower's income were less, we would want to use more patient capital to bring the housing payment to income down closer to the 28% level. But with $59,500 in annual income, the housing cost is prudent. The patient capital provider is seeking 66% of all future appreciation above the $300,000 purchase price, plus the return of the patient capital provided. Let's consider the trade-off implications. If the borrower wanted to own 100% of the equity, they would need to deposit 20% to obtain the lower conventional financing rate. They could use a very popular FHA financing program where the down payment will be smaller, but interest rates and the mortgage insurance premiums will be more costly too. So I'm not ruling that option out, I'm just not illustrating it here. So with 20% down, they need to save $60,000. This could be challenging. Their mortgage payment would increase to $1,288 a month, or $160 more than is needed for the patient capital transaction. But also note that to be closer to the historically stable 28% of housing cost to income ratio, our borrowers should have been making $66,500 a year rather than the $59,000 they have. For this reason, our borrowers decide to play it safe for now. I placed the two payment options here for consideration once again a little later. Now let's see how this plays out if the property appreciates at a long-term rate of 2.5% per year. Now, if the borrower moves in and never sells or refinances the property, In 30 years, they will have no debt and $349,000 of equity in the property. What if our borrower, with the passing of time, finds their income has moved up a little and they're considering setting aside money for a child's education or retirement? Looking 7 years into the future, we note that if they were to pay the loan off then, they would have $74,000 in equity. They could refinance and own 100% of the future value of property appreciation. However, their housing payments would rise with this move. An alternative to this could be to take the former difference between the conventional financing and the patient capital cost structure and invest these 161 pre-tax dollars in a tax-deferred college fund or an IRA, 401k. In doing this, our wealth isn't all tied up in one place, in one piece of real estate in a single market. These savings can be invested in a broader class of assets for better risk-adjusted returns. Here we see the implications of doing this on a voluntary basis from the beginning when the home was purchased. The nice thing about a voluntary savings program like this is that you can turn it on and off as you need. Just one more cushion to allow you to balance life's challenges in this dynamic labor market. You can play with this spreadsheet to explore a variety of ways to enjoy homeownership in a community where you want to live without undue financial risk by right-sizing your housing costs to your income levels.